Hello world. The optimal debt and equity ratio in various funds can vary significantly based on the type of fund, its investment objective, risk tolerance, and market conditions. The optimal debt to equity ratio, DE, varies by industry, but it should not be above a level of 2.0. A ratio of 2 indicates that the company derives 2/3 of its capital financing from debt and 1/3 from shareholder equity, so it borrows twice as much funding as it owns, 2 debt units for every 1 equity unit. However, some very large companies in fixed asset heavy industries, such as mining or manufacturing, may have ratios higher than 2, these are the exception rather than the rule. So, it is essential for all companies to maintain a balance between debt and equity funds. The ideal debt-equity ratio is 2:1, i.e. equity should always be twice the debt, only then it can be assumed that the company can cover its losses effectively. However, the optimal ratio depends more on the type of industry and may vary from industry to industry. A capital-intensive entity may have a high debt-equity ratio indicating that net assets have been regularly maintained and financed through the debts obtained, which would increase returns in the future due to higher production. Different funds have different strategies and goals, so there is no one-size-fits-all answer. So, here are some common types of funds and their typical debt and equity allocation. Number 1. Equity funds. Equity funds primarily invest in stocks and have little to no debt exposure. The debt component in equity funds is usually minimal, and the majority of the portfolio consists of equity investments. The exact allocation can vary based on the fund's mandate and investment style. For example, growth-oriented funds might have a higher allocation to growth stocks, while value-oriented funds may have a more balanced approach. Number 2. Debt funds. Debt funds primarily invest in fixed income securities, such as government bonds, corporate bonds, and other debt instruments. The debt component in these funds is close to 100%, as they focus on generating income and preserving capital. Within debt funds, there can be various subcategories with different risk profiles, such as short-term debt funds, long-term debt funds, and high-yield bond funds. Number 3. Balanced funds, hybrid funds. Balanced funds invest in a mix of both equities and fixed income securities. They aim to provide a balance between growth potential and income generation. The allocation between debt and equity in balanced funds can vary widely, depending on the fund's investment strategy and market outlook. Some balanced funds may have a relatively equal allocation of around 50% to both asset classes, while others may tilt more heavily toward either equities or fixed income. Number 4. Target date retirement funds. Target date retirement funds are designed to automatically adjust their asset allocation over time, becoming more conservative as the target retirement date approaches. In the early years, these funds may have a higher allocation to equities for potential growth, and as the target date approaches, they shift more towards fixed income investments for capital preservation. Number 5. Asset allocation funds. Asset allocation funds aim to maintain a specific allocation between different asset classes, including equities, fixed income, and sometimes other assets like real estate or commodities. The allocation in these funds is determined by the fund manager's view of market conditions and the desired risk-return profile. Therefore, it's important to note that market conditions, economic outlook, and individual risk tolerance should all be taken into account when determining the optimal debt and equity ratio for a particular fund. Additionally, investors should consider their own financial goals and investment time horizon when selecting funds that align with their needs. Before investing in any fund, it is advisable to carefully read the fund's prospectus and consult with a financial advisor to ensure that the fund's strategy and risk profile match your investment objectives and risk tolerance. Did you find this video helpful and informative? If yes, hit the like button. Comment below on which topic you want to see me creating the next video upon. Don't forget to subscribe and hit the bell icon for upcoming insightful videos. Stay tuned.